This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back.
Morning, Gord. Good to be back.
How quickly the month goes and how quickly the priorities of what we talk about change, isn't it?
Well, it's always a crisis of some kind, right? We have that every month, but this one is a different set of things.
Did Yellen catch you by surprise?
No. It would be a surprise if they did raise interest rates, right? When you look at what's going on around the world, and the Fed claims to be data dependent. In other words, they're looking at what's going on out there before they decide how to act. And what's going on out there is mostly pretty bad. So they're in kind of a box right now where anything they do carries the potential for some kind of really, really serious unintended consequences. And if they don't act, they don't raise interest rates, then that implies to the rest of the world that the Fed sees slow growth, which scares the markets, which causes the markets to do what they did today. You know, the equity prices are down around the world right now. And if they do raise interest rates, then that implies that rates are going to continue to go up, which means slow down sometime in the future, which also scares the financial markets. And we're so leveraged, we're so fragile right now that we can't handle any kind of a crisis. You know, even a garden variety equities bear market, 20% drop in the major indexes here and abroad, carry the potential for pushing us into some kind of a deflationary crash, 1930s style depression. And everybody knows that at the policy maker level. They all know that they're incredibly fragile and that any bad thing that happens can push us over the edge. And they've reached the point now where they don't know what to do because they don't know which of their choices will be the one that does push us over the edge. And so, you got to sympathize with the guys who are making policy right now because it's not really their fault. This is a bipartisan 30-year problem that has been building up. It began during really you can go back to 1971 and say it began when we broke the link between the dollar and gold. And everybody went on pure fiat currencies, which in effect are unlimited printing press credit cards for the major governments of the world. Or you could say it began in the 1980s when the U.S. started running big deficits under the Reagan administration and got away with it. We found out it was politically okay to borrow huge amounts of money as long as it was earmarked for societally beneficial programs, which in that case at that time was the Cold War against the Soviet Union, and lately has been social programs and other kinds of foreign adventures and you name it. Now it's considered okay to borrow huge amounts of money. So anyhow, we've built up huge amounts of debt. Our options are very limited, and the guys in charge now have no idea what to do. So I think that 2016 will actually see a shift in gears from this idea that we're going to start tightening and raising rates in the U.S. and normalize interest rates around the world to a renewal of quantitative easing. We're going to find out that growth is so slow and the old quantitative easing programs didn't work, and we have no other choice but to go bigger and badder with monetary ease and debt monetization and negative interest rates and all that. So 2016 is going to be a fascinating year for monetary experimentation. And so what we're seeing now is the lead up to that, is the buildup of the intellectual framework within which that's going to happen.
John, John, you've written a number of articles here I have up on the screen now on Brazil, Japan, layoffs. And there's no question we have a global slowdown happening here, and you can see it in in world trade numbers. Even the WTO, which is fairly conservative, is out now warning about the degree and the problem. And when I was wondering if you could just highlight some of the key points from those articles, and so we could grapple with, are these problems a result of slowing world trade, or are the issues you raised in your article causing a slowdown in the world trade? And if there's some kind of correlation there. And I wonder if we could start with Brazil.
Sure. Well, Brazil, for a long time there, was the Latin American country that got it right. They had built some fairly efficient export industries, or at least apparently efficient. And they were running, if not budget surpluses, very small deficits at the federal level. And the real, their currency, was strong, and growth was good. And it just looked like they were on the verge of becoming a developed country, somebody that you could think of in the same breath as France or Belgium or somebody like that. And then it all fell apart. The dollar spiked, and it turned out that, Brazilian companies had borrowed a lot of dollars because while the real was strong, it was a great deal for them to borrow dollars at really low interest rates, invest that money domestically in high-yielding bonds or resource extraction industries that were yielding big returns. They were making a really nice spread there for a while, and now that is reversed out because the dollar is way up against the real, which puts most of these deals underwater, and so they're in big trouble in a lot of ways. And at the same time, it turned out that there was corruption in especially Petrobras, the major state-owned oil company, and that corruption seems to have gone all the way to the top of the government. And so they've got a political crisis at the same time they've got an economic crisis. Their currency is tanking, they've lost their investment grade rating, and their stock market is way down. And it's not clear what the solution is because they just announced an austerity plan where they're going to cut government spending in order to bring the budget back into balance, hoping that shores up the currency. But we know from Europe's recent experience that that's really not a short-term solution. That causes more trouble than it solves problems. And so Brazil probably has a hard year ahead of it, at a minimum. And meanwhile, the trade thing, for a long time, global trade grew faster than global GDP, meaning that more and more of our wealth was coming from trade. And it turns out that was due mostly to China borrowing $15 or $20 trillion over the last 5 or 6 years, and using that money to snarf up all the available natural resources in the world. So we had a lot of trade, which turned out to be natural resources flowing into China and then cheap stuff flowing back out. So the U.S. consumer was buying stuff from China while China was buying natural resources from the developing world. And everybody was getting richer on paper. And that turned out to be a mirage, too, because it was based on debt. And a lot of that debt was used for stuff that turned out to be malinvestment, things that aren't going to generate the cash flow necessary to cover the related debts. So China is now a big part of the problem. At the same time, the U.S. dollar is a big part of the problem. So you've got issues everywhere now. And it's not clear what the immediate cause of our problems is, or of our problems looks like right now. And I think you could say that it's a lot of different things coming to a head at the same time. And meanwhile, Japan has had the most aggressive debt monetization program of anybody in the world over the last 3 years, where they basically tripled the balance sheet of the Japanese central bank, pumped huge amounts of new currency into the markets, pushed interest rates down even further to zero for a big part of the yield curve, and it didn't work. Japan's not growing anymore. And their inflation rate is effectively zero to slightly negative. In other words, they're flatlining economically at the same time that they're dropping into deflation after all of this new money creation. So it isn't clear what they do next, but the proposals are starting to come out of the woodwork now from the easy money Keynesian side of the spectrum. A while ago, and I wrote this up last week. A University of Michigan professor and New York Times' Paul Krugman came out with similar proposals for what to do going forward. And they both involved massive increases in money creation and government spending. And
Is that any
interest rates?
Is that any surprise from Paul Krugman?
No. Well,
it's never enough for him.
It's not a surprise that they're saying that, but it is a surprise that it's starting to feel kind of mainstream now. This is the generally accepted wisdom in that part of the spectrum of economic thought, and it's moving to the middle. And so I think that's what we'll see in the next year or two, because there is no other alternative. So we will see interest rates be pushed to negative levels in a big part of the developed world, and we'll see cash in one way or another be hobbled as a store of value in order to make that possible, because you can't have freely circulating cash that is exchangeable at face value and negative interest rates, because everybody will just take their cash out of the bank. If the bank is going to charge you 3% a year to keep your money in a savings account, you just take that out, put it under the mattress, right? And so that will suck all the life out of the banking system and make negative interest rates an untenable public policy option. So the Michigan economics prof suggested that central banks of the world just go back on their guarantee to exchange cash for other things. In other words, they aren't going to take your cash anymore at face value. And that will light a fire under holders of cash, force us to spend it because we don't want to hold a depreciating asset. And in that way, pump up the economy and make it possible to have negative interest rates. Krugman, his proposal is to have governments go much, much more deeply in debt. In other words, ramp up the deficit spending, buy real stuff like the materials that it takes to build roads and bridges, for instance, or military hardware, whatever. I don't think from the Keynesian point of view it matters what governments buy, just as long as they're buying stuff that then has to be created in a factory that employs workers. And so his idea is more of a QE for the people kind of thing, where governments give back a lot of money via tax cuts or via spending, and then just finance it with newly created currency or new borrowing or whatever. Either way, these proposals are coming at a time when similar things have already happened over the last 20 or 30 years. In other words, we pushed interest rates down to basically historically low levels of zero in a lot of the world, and now we're going to go negative. We've already ramped up government spending and deficits and taken on huge amounts of new debt post-Great Recession. But now we're going to do that same thing on an even bigger scale going forward. And we're going to do it at a time when we're not in real crisis. The economies of the world are just they're slow, but they're not falling off the table yet. So it's anybody's guess what happens then, because these are policies that have never been tried before on this scale. We've tried QE, of course, and it didn't really work. We've tried extremely low interest rates, and they didn't really work. And so now we're going to take it one step further and build up even more debt and create even more currency and push interest rates even more further into negative territory. And so who knows what happens? I think that there's a point out there when people figure out that the governments are doing the same thing over and over again, and it's never working, and then they react accordingly by losing faith in the currency and converting their currency into real stuff as quickly as possible, and we get the Austrian economics crack-up boom. But I don't know when that is. Maybe the next batch of stuff has the same effect as the last batch and buys us some time. Or maybe it's seen as a sign of weakness by the markets and everything falls apart. We can't know that until we try it, but it sure does look like we're going to try it.
You wrote about the banks, the major international banks, and a degree of layoffs, and these are numbers we haven't seen since around 2008. What's that telling you?
Well, it's another sign that our past policies of massive government deficits, extremely low interest rates, and debt monetization aren't working, because banks, in theory, should be able to make a lot of money in a zero interest rate environment because money's free for them. And then they turn around and lend it out to subprime car buyers, at 3% or 4% or whatever for 6 or 7 years. They make a really nice spread there. You'd think they could make a lot of money. Or mortgages, mortgages 3.5%, 4% right now. So if a bank can borrow money for nothing and lend it out to U.S. consumers and U.S. home buyers at a spread that's 2 or 3 points above what the bank is paying, you'd think they could make a huge amount of money, but they can't. And that's a sign that loan volumes are kind of sluggish, and also that the prop trading desks that most of these banks run aren't making any money in the new world of volatility. When things are bouncing around like this, the bank's traders can't consistently make money anymore. And since the banks have basically converted themselves into big hedge funds, where a lot of their money comes from trading for their own account, if that doesn't work, then they are no longer the money machines that they used to be, and that you would think that they would be in this kind of an environment. And so they got to lay people off, and they're laying off tens of thousands of people, not just nibbling at the edges. And one other thing is that automation is coming to the financial sector. So a lot of the people doing back office stuff right now are going to be redundant, or are becoming redundant, as artificial intelligence makes it possible for banks to set up systems that do a lot of this stuff automatically. So you're seeing technology intersect with bad economic policy to turn the big banks into unprofitable, lumbering behemoths right now that really have to get lean and mean in a hurry in order to survive. And so we're seeing that happen at an accelerating rate. Deutsche Bank and Barclays and some of the big U.S. banks are laying off tons of people. And so then the question becomes, how do you have a growing economy when these big companies are laying people off at an accelerating rate? And Hewlett-Packard, for a different set of reasons, just announced another, 30,000 layoffs, Gord? Some big number.
30,000, and they had just finished 58,000. And these were the survivors. I live up in the Northeast, that DEC, Wang, Data General, I could go on, all disappeared in Compaq, all consolidated, and HP was the big winner. And the result of being a big winner, 58 plus 30, 88,000 people gone.
Yeah, that's an almost unimaginable set of layoffs for one company. And I think you'll see that across the finance and big tech sectors for various reasons. That we just talked about, that automation is making it possible to do a lot of jobs more cheaply with expert systems now than you can do with people. At the same time, that banking is no longer a profitable business. And so you combine those two things, and you're looking at the biggest, most successful companies that have employed the most people in the last few years, turning into the not the sick entities necessarily, because tech companies are still pretty healthy, but from an employment standpoint, they're turning into the big problems for states and localities where they used to be the biggest employers.
They're not, and it isn't just size, John. They're also the ones that paid a good standard of living job and income.
Yes.
And the jobs that we're creating right now, the biggest growth are bartenders and waiters, and they taking out tips. They're not high-paying jobs.
Yeah, and automation is coming to those industries too.
And that's a good point. So, and automation is coming to the retail industry in a wave that you've never seen before. Because they're trying to cut costs and all new different concepts for better service at kiosk types of things.
Yeah, so you're seeing a lot of people out there who had good jobs that required a college education, losing those jobs, and then having to take jobs in retailing or service industries and thinking they've hit bottom. But they haven't hit bottom, because those industries that where they're biding their time until a real job comes along, those industries are being automated now. You can run a restaurant without a lot of waiters, because you can have a kiosk or a tablet at a table where people just punch in what they want to order and then it's delivered to them. You can have a clothing store where people just use a handheld device or a tablet that's on a wall in the department to order things to try on, and then the clothes are delivered to the trying on room. You try them on, you leave them there. If you don't want them, you pop them down a chute. If you do want them, they're delivered to a place where they're packaged for you, and you pay with your iPhone or whatever. You don't have to interact with people in the store of the future. And that means that the jobs that are now done by store clerks and by waiters and waitresses and bartenders are going to go the way of a lot of other factory jobs that have been automated out of existence in the last few years. And it's not clear what happens then to all the people that need to support families with those jobs.
John, I've seen it up here in the Northeast. When I came here, the internet boom was just in its infancy, and I can remember 78 pages in the Boston Globe, small print, job fairs of hiring and recruiting. 78 thick pages of small print of jobs. That wave ended with the dot-com bubble, and then the next wave was people who were in there that I knew suddenly were associated with housing, whether they were brokering, whether they were selling, whether they were renovating, but then the housing wave. So we had all these factories that shut down, then we had all these office buildings. In some way they were associated with the housing boom. That ended in 2008. The last 7 years, there's been this massive retail build-out, and all those people I run into are in the retail business, and that's the next wave that's going to happen. The question, as you just said, is where do they go next? And every time those happened, the pay scale dropped. The real disposable income went down, and it got harder and harder for them to exist. And I'm looking at least up in the Northeast, and I don't see the jobs at all. Ever mind hundreds of thousands of people holding on. So I don't mean to be negative. I'm just a simple observation in one part of the country. John, we're up against our heart. Sorry, you were going to say something.
Well, I was just going to say, yeah, it's kind of a perfect storm where we have 2 or 3 different things working against people right now because we've borrowed too much money, and that's slowing down growth. Even in the absence of any kind of new technology coming along, we would still have a financial crisis on our hands.
Yes.
But it's the crisis that we have brought about, that we baked into this cake, is coming at a time when technology would have caused an employment crisis in any event. So we got these things happening together. And and also at the same time, we've got geopolitical stuff going on out there where our stupid foreign policy has led to a really gigantic conflagration in the Middle East right now that's swamping Europe. Europe would have a crisis on its hands just trying to take care of all the Syrian refugees if they didn't have a financial crisis. But now they've got financial problems and a technology crisis and an immigrant crisis happening all at the same time. So yeah, lots of bad things are happening all at once, and it really isn't clear how we get ourselves out of this, because any one of them would be something that would cause a bear market in asset prices and political crises around the world, and maybe geopolitical crises where some kind of a war starts because of the effects of these things. But they're all happening at once. So yeah, very interesting 2016 coming, Gordon.
John, we're up against our hard line. Can you tell our listeners how they could learn more about your writings, how they can find your writings and follow your work?
Yeah, I run dollarcollapse.com, which is a site that covers a lot of the stuff we talked about. And my latest book is The Money Bubble, co-written with Gold Money's James Turk, which also covers a lot of this stuff and includes a lot of investment advice about how to deal with the crisis that's coming.
So many of the things you talked about in Money Bubble are in the daily news now, are unfolding right on track. So
they are.
It's a good place to go look at a roadmap of what you can expect to come. John, talk to you again next month.
Great.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.